Imagine a case where the United States government actually wants the gold price to explode higher. Why would they want that, and what would that look like in the face of the rest of the world as the world is breaking apart and seemingly racing for another reserve asset? That's the topic we're going to explore today. I'm sitting down with Luke Gromen. He's the founder and president of Forest for the Trees, FFTT. An amazing newsletter. I was just telling him it's like the only one I read every single week. We'll link to that down below. We're going to sit down. We're going to talk through the situation that we're having in the United States and really the rest of the world with debt, the potential outcomes, how that unfolds, and so much more. So let's just jump in. Luke, thanks for joining me today. We've done a couple interviews. The first one live, so
likewise.
So stoked on that. So we are going to do a panel later today talking about out of control government. So we'll get into that later, but let's just dive right in. So there's a situation where the fiscal problem in the United States is out of control, and that's kind of the head of our panel. So why don't you just frame up this out of control situation that we're in?
The out of control situation, there's a couple of factors to it. The debt to GDP of the United States, deficit of the GDP, both as a percentage of GDP, are so high that the U.S. needs to have nominal GDP growth consistently run above the interest rates on the debt. So little g for nominal growth of GDP, and little r for rates is the parlance in the economics world. And we have to have G stay far, not just above R, but far enough above R to keep the debt sustainable, to keep from going into a debt spiral. Problem is with the absolute levels of debt that we have, almost $36 trillion now, what that implies is that you need, to be blunt, a sucker at the card table with enough balance sheet to be able to take real losses on a real basis on $36 trillion in debt in aggregate. And of course, there's no private sector entity big enough that is able to do that. And the higher the debt goes, the more G has to be above R, which means the more the holders of our debt have to fall behind on living standards. Our growth outpaces the interest rate we're paying them on our debt. And that just, there's not an entity big enough with a private sector balance sheet to do that. And so, of course, it falls to the Fed or Fed proxies. And so that's the fundamental problem. You can dig into why that's happening, the structural nature of what's happening as it relates to entitlements, defense, interest being the biggest three expenditure items by far, some other things in terms of just deflationary pressures of productivity, AI, et cetera. But that's the fundamental issue is G has to be far enough above R, and there's nobody with a balance sheet big enough to do that on $36 trillion in debt.
Yeah. Now, there's a couple variables in there, though. So one, we're trying to grow the the GDP, and we could do that through inflation. We could do it through a productivity miracle, right? There's other ways to do that. But also, you talk about the true interest expense. So that's you said the entitlements plus the interest. Mm-hmm. So the rates could just go back down to 1%, and that would greatly help that situation, right?
Yeah, absolutely. And that's, the key ultimately in this is that higher rates of inflation are in the cake. So, right. When you look at, we need to keep G above R, we need higher nominal GDP growth. You can do that via inflation. We saw that, and that can work. But again, that weakens, the more we have high inflation, the less incentive there is to hold the debt so far below that rate of inflation, the more impetus that puts on the central bank to buy it or their proxies to buy it, the more inflation goes up, and that gets into that issue.
So if they lower rates, then there's even less demand for the treasuries than there is now, which means the Fed then has to print and buy more of it.
Conceivably, yeah. So if you in theory cut entitlements, but you probably really can't. But that's a separate discussion. But if you cut rates, in my view, there's going to be two impacts to that. There is going to be the accounting impact, which is given how much debt we have. If you cut rates, you're actually probably going to lower the deficit outlook over the next 6 to 12 months because, $36 trillion in debt. If you cut rates from, 5.25 today, let's say they cut it to 3, that's 225 basis points, let's do it to 3.25 to make the math easy for me. Okay. 5.25 to 3.25, they cut rates 200 basis points in a compressed period of time. You are going to reduce interest expense 12 months from now by 200 basis points on 36 trillion, $720 billion, which is meaningful on a deficit of 200 billion.
Yeah.
Or excuse me, 2 trillion. That is meaningful. That it would also probably slow growth a little bit because you're going to be putting out less interest to asset holders, to treasury holders domestically and globally, paradoxically. However, you're also going to be sending a message in terms of the animal spirits, multiples, etc., to the markets that you are cutting rates aggressively with nominal GDP still growing at 5 to 5.5%, with unemployment at 4%, basically full employment, and with GDP or CPI running still a little over 3%, above your, comfortably above your target. Yeah. So I think it gets into this very delicate situation where mechanically cutting rates aggressively will slow growth, it will reduce the deficit, but it's all, and so in theory it has a disinflationary impulse on one hand, but then I think ultimately it will be inflationary because I think the markets will read what that is for what it is, which is the US is in a form of fiscal dominance. The Fed is cutting rates because it has a fiscal crisis that is accelerating. And when central banks cut rates to address fiscal crises, the price of stuff goes up, not down.
We're in a world today where information is abundant. The old problem used to be getting the right information. Today we have just too much of it, so we have to learn how to discern it. Do you think it's probable to think that any government that's somewhat intelligent, which I'm guessing is most of them, looks at the US and doesn't see that we have a fiscal problem? Like, you're saying that we're going to tell the world we have a fiscal problem. Don't you think they already realize that?
Oh, they know it, and so does the US. Right. So does the U.S. So
I mean, we've seen warnings from the IMF, yep. Right? We've seen. I mean, they're.
Yeah, they all know it. And you can see it in the. For me, I always want to hear what they have to say, but I put more credence, I put more weight on what they do. And so, global central banks stopped buying treasuries on net 10 years ago.
Right.
They've been buying gold that whole time. They've significantly accelerated it since 2022 with the sanctions on FX reserves of Russia. They have put on. Some of it by nature of the structure of the system, but I think some of it by design. They've borrowed a lot of dollars, and they've bought a lot of U.S. assets, which is, that's an expression of that view, which is when people say, well, they're still borrowing in dollars. The Saudis just borrowed, $2 billion a few weeks ago in dollars. People say, well, see, the dollar's still dominant. The dollar is still dominant, but there's another interpretation of that expression, which is the Saudis just shorted $2 billion against oil. So I think when the
speculative attack.
Yeah, I mean, and it's some of it's just a structure of the system, but I think it's also just smart hedging. Now, I don't even think it's a speculative attack. I just think it's going with the energy. It's going with the flow. When yes, foreigners have borrowed $13 trillion in debt, but they also have $22 trillion net in U.S. assets, $57 trillion gross. So you're in this sort of Mexican standoff of mutually assured economic destruction, where if the dollar gets too strong, if we weaponize the dollar against those dollar borrowings, we actually end up hurting our markets, hurting our revenues, hurting our economy more faster than we're able to kneecap our adversaries with the dollar. And we've seen that repeatedly since 2022. So I do think there's absolutely an understanding globally, and in particularly at the central bank level, the message of stopping buying treasuries and buying gold couldn't be more clear. They don't need to be right. They don't need to get the timing right, but they know, and they know what the situation is. And critically, by virtue of them doing that 10 years ago, they accelerated the whole thing meaningfully.
So it's almost like the only way out is inflation. One way or another, just where do you want to see it? Do you think, you hear about the Fed talking about bringing inflation back down to 2%, of course, the Biden administration, prices are too high, et cetera, et cetera. But at the same time, it almost seems like inflation would be easier to digest than deflation. like even maybe for the American people at some point. I mean, obviously the poor people really get hit high with inflation, but the more affluent people see their asset prices go higher, they can raise their wages, your 401k account doesn't crash. Do you think inflation is the easier choice to make? Not just for the government to stay in power, but even maybe just for the people?
I think it is the easier choice. I mean, deflation is always an option, but because the debt and deficit levels are so extreme, what we're talking about is in practical terms, is a new Great Depression, slashing entitlements and defense spending in the U.S. by 25 to 30% overnight, permanently, which has severe political implications, probably pretty quickly into an already politically unstable or increasingly politically unstable situation.
Yeah.
So ultimately, I do think inflation is the only way out. Now, depending on how you structure that, you can make that good for the middle and working classes. And there's an argument to be made that's the fundamental, or one of the fundamental cruxes of this election, which is which group of people are going to suffer it. Because if you have a wide open border, unrestrained immigration, and you inflate, what you're going to do is you're going to have asset prices rise significantly. You're going to have the top 1% do really well, and you're going to have sort of everybody else, the bottom 90 to 95%, seeing inflation rise faster than their wages,
right.
Because you're going to be restraining wages with immigration. That is a recipe for a revolution. That is, but a revolution at some undetermined future date. That could be 2 years, 5 years, 10 years, 20 years, 30 years. You don't know. And politicians famously would always rather take pain tomorrow at some undetermined time
or
than
60
on their
or 80
watch.
years from now.
It could be 60 or 80 years, absolutely. On the flip side, you can look back and see when Trump reduced, and I'm not I'm not stumping for either candidate here. I'm simply looking at it as an objective observer. When immigration levels fell under Trump's first administration, the bottom 50, bottom 70% of wages grew faster than the top 1 to 10% of wage earners for the first time in like 30 years. And so it's fascinating to hear the narratives around the Trump-Harris. It never touches on this, and I think it never touches on this for a good reason, because saying we want more immigration so that the 1% can make more, so that corporate profit margins can remain at all-time highs or higher, which is what the inflate plus open immigration does, it's not a winnable platform. You are going to get killed in an election on that. So you make it about other social things, and you denigrate and you call names, but you don't, whatever you do, you don't do that, because if you inflate and you significantly restrain border, now you get a different outcome, which is actually a really good outcome for everybody that has not done as well as the top 1% over the last 40 years, which is to say asset prices are still probably going to go up. Corporate profit dollars are going to go up with the inflation, but corporate profit margins are going to go down. Wages for the bottom 50, 70% of Americans are going to go up because inflation is going to go up and growth is going to go up, but there isn't going to be the cheap labor around and so basically corporate America is going to have to pay up for the labor that is here. Then you get into things like tariffs, et cetera, but that ultimately starts to be a situation where the middle and working classes actually recapture some of what they lost over the last 40 years. Asset prices still go up. They don't go up as fast, perhaps. The bond market gets killed on a real basis because now we're talking about sort of a wage spiral, if you will, for some period of time. The Fed probably has to be involved with some sort of yield curve control, which they probably would on the other side. But on the other side of that, you end up, especially if it's married with some sort of industrial policy, et cetera, with a much more stable, less divided country, something that's really good for America. And so you basically, that inflation flips on its head the winners and losers of the last 30, 40 years, which is Wall Street and certain Washington interests won on a relative real basis over the last 30, 40 years. They would lose on a relative real basis under that scenario. Yeah. And that's what needs to happen. For the U.S. to win, the real value of the U.S. Treasury market needs to lose badly.
Yeah. I'm really interested to dig into the mechanism of energy and oil and gold and Bitcoin, but I want to stay on this thread just for a minute. So if you think about that, I mean, so we're sort of reindustrializing the base, but not allowing the big immigration numbers to come in, which then means the Americans get more jobs, I guess is kind of what you're saying, right? But if you think about that, then, I mean, that's going to push the prices of those assets, or not the assets, but the goods and services way higher, right? A $10 part in China is now $100 in the United States. So while I guess that's good, we have more people working, then also theoretically, the cost of goods is going up faster than their wages are. So technically, they could still be crashing.
Yeah, I think it's you will still probably have necessities going up faster, right? You'll have, you know, food and what have you. So it is there's really no
Goldilocks
pain.
scenario.
There's no Goldilocks scenario. It's about choosing who's going to take sort of the brunt of the pain. And so if you are the average American with a fixed rate mortgage, and that fixed rate mortgage is 3%, 4%, and your wages start growing 15%, that's a debt jubilee on your house, on your car, etc., on your student loans, on all of it. All of it, the coupon on it doesn't adjust.
Yeah.
Your wages grow 10, 15 for the span of 5 or 10 years. Yes, your grocery bill is probably going to grow 17, 18. Yes, your heating bill and your cooling, those things are probably going to go up.
Yeah.
So,
really just it would drive the cost of labor up. And so, you know, homes that are already made in America probably wouldn't change a whole lot necessarily. Things that were made in America probably wouldn't change. It's the stuff that's made overseas that now has to be made in America that would probably greatly
go
increase.
up a ton, exactly.
And so then I wanted to then dig into, because you talk a lot about hollowing out the industrial base. So Triffin's dilemma, right? So we had to, because of the reserve currency of the world, we had to offshore our manufacturing so we could offshore our dollars. And I think about that, and then, you know, there's obviously the national security imperative of like, shoot, we should probably build stuff in the United States. We found out the hard way. But just in terms of sort of reindustrializing the base, something I think about, and I want to get your opinion on, is that the world changes, and most likely, or mostly driven from technology. And technology removes low-level tasks so we can focus on higher value tasks. So Industrial Revolution, we had mechanized machines that could do the work of all the guys in the field. All those guys are out of work now, and then they went on to do science and medicine. That was great, a great trade-off. And we had that Industrial Revolution, which then people moved into cities and factories, and we had mass production. So Henry Ford created the mass production, right? And so when we had that in the United States, we had assembly lines everywhere, and it made everybody equal. Mm-hmm. Smart people and dumb people worked even, and they just put the piece on the machine as it went down. And I believe, like, and sort of the way I look at it is that created this massive middle class because everybody became equalized, and they were doing good work. It seems, though, to me now that those are low-value jobs. So we've offshored those to China or Asia or wherever those are, but those are low-value jobs. So we could bring those back, but that's almost like we could just also put everybody back into the fields and pick cotton and corn, too. So one, from the strategic side, or like I said, the national security side, I understand the importance, but do you really think it's that big of a deal to bring really low-skilled, low-paying jobs back?
Well, I think there's the low-paying, low-skilled stuff. It depends on where it is, right? So, you know, you've got the U.S. Navy basically begging people on TV ads to become a welder, right? You can become a welder and make really good money, make a really good living right now. So those types of, you know, skilled trade jobs, I think there'll always be some sort of good demand for. Some of the challenge that you highlight in terms of those shifts of labor, you know, this is around the Industrial Revolution. You know, I find it's going to be a little dark here, this little part of the interview. We tend to skip over, like, as humans, and I think it's probably just a coping mechanism, the real implications of that. So, yes, we did do the Industrial Revolution, late 1800s, take people out of the fields, put them in the cities. What we tend to, and ultimately higher value added stuff. What we tend to leave out are the disruptions and the costs of those disruptions. So we did run through a cycle like we're going through now in the late 1800s, Industrial Revolution, et cetera, like you described. And we ended up with what we've gotten. But in the middle, we had 1913 through 1945. And there was some portion of those wars, disruption, tumult throughout the northern hemisphere that was caused by, it was an economic issue. It was, and you could even go back and make arguments that the US Civil War actually had, the South had 60% of the wealth in this country in 1855. And the North had the minority. And the northern industrialists that were doing some of the productivity stuff, et cetera, there was an economic clash that was, slavery became the focal point, but it was in no small part an economic political power struggle between the new money northern industrialists and the old money southern plantation owners, agrarian society. But 1913, 1945, we have all these massive changes, all this disruption, and it leads to power struggles. And from the math, I looked at it a few months ago, 7% of the world, 7% of the world's population that was alive in 1913 died over the next 30 years in wars.
Right.
And so these transition periods, like as economists, as analysts, we go, well, yeah, we went from industrial revolution and the progress of human, it's like this. Well, it's like this.
Nothing goes up or down a straight line.
No, exactly. So that I think that model, that analog highlights some of the challenges of what we're living through, which is how do we want this to look and how do we try to manage to avoid that? Because, practically speaking, from 1913, 1945, by 1945, 7% of the people in the world alive in 13 had died. And by the way, not that many died in America in the grand scheme of things. We lost 450,000.
You're talking about just in the war.
Just the wars, just related to the wars. The Russians lost 27 million, right? So
a lot of 25 of those were they killed their own people.
Killed their own, and these are these economic, these changeovers of great power, right? In 1913, there were 4 great empires. So by 18, there were 1, right? There was only 1 left. So. And I think a lot of this is these political changes that are driven by these economic changes that are driven by these, productivity enhancers and the way that starts to redistribute wealth, et cetera. There's the long-winded way of saying there's not a great answer to it. I do think that a lot of those jobs could come back because then it feeds on itself. There is a domestic service society. There are 4 service jobs for every manufacturing job. I do think, look, the robots, et cetera, automation, it's not going to go back to the 1940s, 1950s forward. And by the way, the other way the U.S. had a middle class was because 7% of the world's population and its entire factory base had been destroyed from 14 to 45. And you come home and the Americans sort of have all the people, all the factories, and so we couldn't help but have a period of time where we had that. And to your point, that was a unique moment in time. Very quickly, the Germans got back on their feet, the Japanese got back on their feet, and they're very productive, very industrious, very skilled tradesmen, and they make great products. So they started competing with us, and we get into the late 60s, 70s, right? That all of that kind of fed on itself. So I do think your point that there's no sort of easy button to fix this. I do think that sort of the days of like, hey, the 40s and 50s middle class, that's probably gone, never to come back. But I do think there's somewhere between that and sort of what we have today, both from a economic, political stability, middle working class, and then national security imperative where I think there's some sort of happy medium we can move toward.
The national security is like, of course, like we should be able to build or create medicine and toilet paper and ammunition in the United States. That's a given. But also, it wasn't just competing with Germany and Japan, et cetera. It was really a shift from industrial era into an information age. And so today you work out of your home office with your laptop and you're just on your own. And I travel around the world with my cameras and my laptop and I'm just on my own. And so in the information age, we don't need the industrial, we don't need the workforce, we don't need the assembly line, and it really turns into a lot more of a meritocracy. So back to the assembly line, equalizing everybody. Now in the information age, it's a meritocracy where if you're smarter or work harder, you can really get ahead. And unfortunately, it seems like more people are falling further and further behind. You talk a lot about the drug epidemic that we have in the United States, which could be somewhat attributed to losing the jobs. And I think you kind of pinpoint it that way, right? And they're the desperation, and they turn to drugs, et cetera. But yeah, that meritocracy in that information age, and it's just a sort of a function of the world that we're going into. And I just don't really see a way that we can resolve that. So I guess that was question number one. Does reindustrializing the base really make that big of a difference? And I'm guessing the answer was maybe not so much.
I think it does, because part of it is the currency, right? So part of the reason I'm in finance, I made a conscious decision when I was in college, right? So I went to the University of Cincinnati, one of the top 5 architecture schools in the world, or in the country, and I got into the architecture program. I was going to be an architect, and a quarter and a half in, I hated architecture. So okay, I'm going to go engineering. I'm going to go into finance. And in the late 1990s, mid 1990s, number one, engineering, all my engineering buddies never got to go to the bar because they were all working really, really hard and having to study just to keep their heads above water. And all my guys in finance were like out at the bars 4 nights a week, and the tests weren't that hard. And oh, by the way, they were making way more money when they graduated, and way more money 5 years later than 10 years later. And a lot of the industrial companies the engineering guys were going to were getting offshore to China. So it was like, for me, I made a conscious decision. It was like, well, I could go either way, but what's best for me, where this is the system my leaders have given me, the answer's clear. And I can't be the only person. And we can see it in terms of the empirically in the share of jobs that went into the FIRE industry, right? Finance, insurance, real estate, from the mid 90s on, after NAFTA and then China and the WTO. So point being is, yes, there's this information age, but some of the information age is a function of the currency system shifts. I mean, yes, I think what I do is very valuable, and if the plane you and I fly around on to go to these places, the wings fall off. It's one of these things where there is some level of minimum competency and domestic engineering capabilities that are necessary for quality of life, and then that gets into some qualitative issues of like, okay, well, what is the guy who, are the engineers who, engineer these airplanes really worth whatever they make, 1/5 what some derivatives trader on Wall Street makes? No, they're probably not. It's just that he's a derivatives trader in a financialized system. So there's some element, yes, the economy is absolutely switching. Yes, it is absolutely more information based. And some element of this inequality and this that we've described is a function strictly of the fact that we have devalued these jobs. How much money would I pay to make sure my plane was never going to crash? A lot. Right? And how much money would I pay a derivatives trader to make sure my mortgage stays locked in? Like, it's, you know what I mean? It's not. We've gotten a little bit of, so I do think there's a shift, and I don't think there's any stopping that shift. But I also think there has been a perversion of relative value of tasks in our economy by the currency system we've been living in that has to be backtracked, or else, like, look, we're not going to be able to fight wars. We will not be the hegemon because we will not have the weapons. We won't be able to make planes. We won't, so there's some, happy medium there, I think.
So you're saying that, yes, that information age and that shift has happened, but it's also because of a perversion of the fiat monetary system that we have and the financialization of all the assets that have now created this overvaluation of trading derivatives that really provide no value to the world. And so it's a function of the system, which I tend to agree. As a Bitcoiner, we think about, well, if we had more of a sound money system and our money held its value, we didn't have to become these investors. Right? And so imagine if I could just be the best inventor, brain surgeon, cancer researcher in the world, but now I'm only 50% of that because now 50% of my time is thinking about investing so I don't lose my wealth. Right? If I didn't have to lose my wealth, then I could just save and I could just focus on being the best inventor, and then all of Wall Street just kind of goes away. I don't need that. It
right-sizes itself, right? I mean, I literally know of a case, maybe this was probably 10, 15 years ago. It was in my former life. It wasn't while I was at FFTT. It was in a former seat. there was a medical professional who had trained for 16 to 18 years to operate on one of the most sensitive parts of the human body. So 4 years school, 4 years med school, they're not even practicing till they're like almost 40. So, and there's probably only a couple thousand of these people in the world operating on this part of the body. And they quit that job to become a healthcare analyst at a hedge fund because they could make way more money and they didn't have the legal risk of getting sued for malpractice.
Yeah.
And I remember hearing this story because the person was a client of a colleague of mine sitting on the sales desk. And I just remember thinking, how fucked up is this?
Yeah.
Like this is such a gross misallocation of resources. So it's not hypothetical, you know, especially when you see, and oh, by the way, when you live in parts of the country where housing, education, et cetera, are bid up by that, right? Yeah. It's a lot more affordable to live in Cleveland where there aren't a lot of derivatives traders than it is in New York, where it's much more financialized. So it's a winners and losers situation, but there's a tragedy of the commons problem that was 15 years ago. That's really saying something. Now, when we've got problems with very obvious problems with U.S. manufacturing, very obvious problems with the U.S. ability to supply weapons, make weapons in any kind of timely manner. The economists were saying, oh, well, just let the markets work. Just let the markets work 15 years ago. And the Chinese are saying, like, keep reading those stupid books. Things are going great for us. And the military, around 10 years ago, finally said, we're borrowing money from China to build weapons, to face down China using Chinese components. This isn't a sustainable strategy. Yeah. Like, stop. And so I think that's kind of been an evolution we've been through over the last 10 years.
Another thing I want to talk about is you often reference, almost all the time in your newsletters, barring some sort of productivity miracle, this is where we're going, barring some sort of productivity miracle. A lot of that is about unlocking like cheap access to energy, nuclear fission, some sort of thing like that maybe. And I had tweeted at you and then I saw you write a whole thing about it, but could AI be one of those productivity miracles? And basically thinking that it's not really AI, it's just LLMs, right? Language models, but it is improving efficiency for sure. Like just for myself, the amount of data I'm able to churn through, I feel like I'm in that movie Limitless. I can just like get through data. I've easily added the work to my business of 2-3 people at least. I didn't fire anybody, but I'm doing more than I was before, right? And so if these large corporations don't necessarily have to fire people, they could just do more work than they were doing before. If they were 2 to 3% more efficient, which in a lot of businesses, especially information businesses, they could be 10, 20% more. But let's say they're 2 or 3% more efficient at a stock market ratio of 20 times PE or something like that. I mean, is that a productivity miracle?
It can be if it arrives, I think, at just the right pace. If it arrives too slowly, then we go back to point one, right? Which is fiscal crisis, blah, 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 everything we're talking about.
What's too slowly?
I don't know.
Okay.
We'll know, right? That's if the debt, and this is where it's tricky to know. It's if the fiscal, if deficits and debt continue rising, it's not arriving fast enough. So that's probably a pretty good way of judging that. If GDP, if debt and GDP, if growth, if G is not, growing fast enough above R without inflation, is probably another good way to look at it. But the flip side, and this is the side I wrestle with a lot, but we have a model for this, right? We have a model for a productivity miracle. It was called China into the WTO. And no, you may not fire people, but there's, I don't know how many, 1 million kids graduating every year. I don't even know the numbers. Probably 3 million kids a year graduating from college, something like that. Say 1% of the population graduating from college every year. And you're not going to hire them.
Yeah.
And then you're not going to hire the next ones. And you're not going to hire the next ones. And like, I hear all the time, America has the best demographics of the world. And that's true, basically, of the developed world and some of our adversaries. I don't think there's been enough thinking done about what that means in an AI automation, AI robotics world. Because you know who has great demographics? The Middle East. They have unbelievable demographics.
Sure, they have a lot
lots of young people.
Yeah.
Lots of unemployed young people. And it's not very politically stable.
Right.
Because old people without jobs, they don't protest and riot. Young people without jobs, they protest and riot.
Yeah.
Bad things happen. So if it arrives too fast, if the AI arrives too fast, then you do start getting layoffs and what have you. Because sooner or later, I mean, look, the AI, the information, it's not going to be linear. You're not going to go like this with the stuff. You're going to go like this.
Right.
And so in a year or two, maybe you will fire people, or the hypothetical person will fire people. And so if it arrives too fast, with debt at 125, 22% of GDP, deficit 7% with full employment, and corporate debt where it is, and consumer debt where it is, now you start having people, we know how this goes, in subprime. They lose their jobs, default on the house, default on the car, credit cards. Okay, now we layer that onto a banking system that's already has some issues with commercial real estate. Now what do the banks do? Well, the banks have one thing they can sell to raise capital. It's treasury bonds that they were forced into buying on some level over the last 10 years. They start selling treasury bonds. And so there's this paradox where if AI and productivity arrives, these technology productivities arrive too fast, it's actually highly inflationary, if not hyperinflationary. Because if it creates efficiencies too fast, you're going to reduce employment, because that's the definition of productivity, doing more with less. And doing more with less people is going to result in increasing defaults of consumer loans, which will quickly lead to banking strains, banking failures, and then we're right back to point one, which is, do the federal policymakers step in and let banks fail, and let depositors with over $250,000 in the bank take losses? Because if we do that, then it will be then AI will be deflationary, and we will have a new Great Depression. The reality is, you and I both know, there's zero chance they're going to let depositors over $250,000 do that.
Yeah.
And so what they're going to do is they're AI moving too fast, productivity moving too fast, ensures that the date that the Fed will have to fully reserve the banking system, which means print all of the money to match the liabilities, it pulls it forward. So that's why I say it's like the productivity miracle. There's other things you can, in theory, do, but from the AI standpoint, Jeff Booth's book, A Price of Tomorrow, gets into this tremendously, right. Which is, this deflationary impact it's fundamentally incompatible with a debt-backed system.
Right. We
have a system that is a debt-backed system. It is highly levered, and you are going to make the debt start to default. And when the debt that backs everything starts to default, when your denominator shrinks, defaults, that's a hyperinflationary scenario. So that's just the economic side. Then you get into the political side, which is, China's demographics stink, Japan's demographics stink, and relative to ours. But do they? If AI can all of a sudden do the work of 10 people, 20 people, 50 people, aren't you better off having fewer young people than more young people, unemployed young people? Or do those young people create more with it? That's the $64,000 question. And the optimists will tell you, though, they will do more and you'll be lifted higher, and that could very well be the case. The pessimists will say, no, they won't. The realist scenario is probably what we went through from 1890 through 1945, which is, wow, look at all this productivity stuff. We got trains, and we have jets, and now we have cars. We don't need horses, and holy cow, we're going to fight over the new economics of this new thing. We're going to kill 7% of the people in the world. And then in 1945, we're going to have a new system, and that's what we're trying to avoid. So that's, there's, as with anything, it's not black and white.
So it's both, and it's over what time frame, and it's this. Right, so nothing goes up or down in a straight line.
Yep.
So, I saw your report, and you kind of back to the WTO, and so that productivity gain also created a crash, and then we reabsorbed it. And you would imagine back in the Industrial Revolution, you replaced all those field workers with machines, and now they're all out of work. Mm-hmm. So now there's this huge unemployment problem. But eventually they find new jobs, so there's a dip, and then they get going again. The problem that I'm afraid of today is that, in the Industrial Revolution, if you didn't work, you didn't eat. So those people were very motivated to go back and get new jobs. But now with this sort of welfare state that we're in today, we're incentivizing people not to get back to work. And so I am on the side that productivity miracles and robots and AI will always be bullish and be good. only because I'm bullish on human ingenuity. And I don't believe there's any utopian world where humans don't have problems anymore. And as long as there's a problem, then there's a solution that's needed, and there's a job that's there for that, right? But only if we're able to continue to stay innovative, as opposed to sitting in our house watching Netflix and getting UBI.
Right.
And so that's a risk. Now, it sounds like almost any path forward is inflationary.
Just about, yeah.
The proverbial rock in a hard place, there's really no choice, because the choice of saying, like, pack it up, boys, it was a good run, like, let's just shut everything down and wipe the debt, like, that's not really realistic. So the only way is to keep the printer full of ink and just, like, keep it going.
Yeah, you've got to, and that's, your point about the welfare state or the entitlement, sort of these social backstops. They're a relatively new phenomenon, and that gets into that, that feedback loop of, okay, if we cut that off, then what are the other? You can get deflation in that scenario.
It's the animals in the state park that no longer get fed. What happens to them?
Yeah, I mean, it's right. There was a great article a couple weeks ago. I'm sure you read it in my report a couple months ago about, this time we're the horses, right?
Yeah.
So, yes, and the number of horses in this country went from like 50 million to 9 million in like 10 years. and yes, the path of product, but like what, who's the horse this time, right? And that's the question, and that there's a feedback loop depending on how that goes through, where you could get a moment of deflation, but ultimately, given the political and power structure across the world, unless central banks and policymakers in the U.S. and in the West more broadly, around the world more broadly, are willing to sit aside and let sovereign debt nominally default, then no, there's really not a way out. That's not inflationary.
It can't default, right? Because in a debt-based monetary system, all that debt is an asset for more debt.
It can theoretically, but you raise a great point, which is it is an asset. It's somebody else's asset. So, right, if the debt defaults, it's somebody else's asset, so they stop spending, they're poorer.
And it's collateral.
But the collateral side is where it gets really interesting, because if that defaults, what you have is $130 trillion global bond market flee into anything else. So ironically, it would probably be hyperinflationary. You basically, that collateral go, and gold would probably replace it overnight, and that's pretty easy to do, really. Like gold goes to 50,000 an ounce, 20,000 an ounce, whatever that number is, and you move on. And that's actually a way more stable system because it's not a debt-based collateral.
Right.
That's a separate discussion. So it can theoretically default. The fact that it's collateral is very powerful information for why they will never let it default. Right. They will always print the money.
Right. So let's go through the mechanism then of how the energy and gold is starting to sort of reprice that. So you talk a lot about sort of money being energy, and so oil, maybe the energy in Bitcoin as well, that mechanism, and then how potentially what China's doing with their gold, kind of the way they're recycling gold and allow people to convert, and how that may force the U.S.'s hand.
Yeah, so ultimately, one of the other problems driving a breakdown of this post-$71 system as it's been structured has been peak cheap oil, which is to say we're not running out of oil, but we're running out of the cheap oil. 90% of the world's global oil production growth over the last 10 years has come from U.S. shale. That's per Goring and Rosenzweig. That oil needs to be 60, 65, 70. If it goes below that, production that's going to roll off, growth of that production will stop for 3 to 4 years. We know that because we saw that in 2019. Peaked in 2019, finally retook 2019 levels in 2023.
Okay.
The problem with that in this system, if you're China, Kyle Bass laid it out beautifully 4 or 5 years ago with Hedgeye, where he said, look, the Chinese have a growing economy, they need to import more oil, they can only buy oil in dollars, and oil prices are going up. And so they're going to run out of dollars, and then they're going to have a currency crisis like they had in Southeast Asia in 97, and the CCP is going to collapse, so on and so forth. You want devalued, CCP is going to be under pressure. Okay.
That's Kyle's favorite scenario.
He likes that scenario,
Yeah.
yes. What the CCP saw that too. They are very pragmatic about this. And so what their solution was two things. Number one, stop buying treasuries and instead start using those dollars to buy up oil fields, ports, boats, the whole infrastructure, fund a military. The other thing they did was that is much more sustainable and that is forcing this systemic change in part is begin setting up the infrastructure to buy oil and other commodities in Yuan. And people say, who's going to take the Yuan? Well, the oil exporters will take the Yuan. What will they get with it? They'll get Chinese-made goods. We're all buying Chinese-made goods. Everyone's, thanks to the way this system has evolved, China's the factory of the world. Okay, what will they settle in? The Chinese don't want to open up their capital account with Chinese government bonds. You're right. They'll use gold at a floating price. And what does that do? Well, it does two things. Number one, it gives credibility to take the Yuan because everybody loves gold. Everybody trusts gold. And number two, unlike the American system, which she started at the top of the hour with, where America needs G to be above R. In other words, if you hold our treasury bonds, we must steal your purchasing power just to keep, our bellies full, just to keep the wheels on the cart. Chinese are saying, look, net settle in gold, and the price of gold will go up over time in Yuan terms, which means your purchasing power in Yuan terms, the factory of the world, will go up. It's a virtuous cycle. The more oil goes up, the more Yuan goes down against oil, the more gold goes up against oil, the more gold is used, gold goes up in Yuan terms. Creditors of China on the energy side can buy more Chinese goods with Yuan, more Chinese goods, stronger Chinese economy, more oil usage, wash, rinse, repeat. So right. The interesting...
Is that what you mean by the floating price of gold?
Yeah, floating price of gold. You can see...
As opposed to what would be a non-floating price
of gold. Pegged. Yeah, they're not pegging the Yuan to gold. The Chinese understood the Americans made two mistakes with the gold standard. They pegged the dollar to gold, mistake one, and number two, they used their own gold to settle. The Chinese have fixed both in the structure of this. Number one is floating. People saying, the Yuan's going to devalue, it's going to crash devalue, it's going to go down huge against the dollar. Yuan's down 50% against gold in the last 18 months. People are missing the movie. They're missing the whole show. Number two...
So the Yuan is not losing to the dollar, but it's losing to gold.
It's getting crushed by gold, which is what they want. Because, by the way, their creditors are getting more purchasing power. They've been telling their people to buy gold for 20 years.
How are they getting more purchasing power if the Yuan is losing value?
Because
they're not saving in Yuan, they're saving
in gold.
So the gold is going up, which is purchasing more in the Yuan.
Exactly, which then keeps the factories full in China. So it's so that's the first mistake they know the Americans made and they fix it. And the second one is the Americans use their own gold to settle, right? So that's why we had to close the gold window. We were bleeding it all out.
Right.
China's like, our gold can't leave, except over here in the Shanghai Free Trade Zone, right? It can come in there and leave, but mainland China gold never leaves. So you got to get the gold from somewhere else. This is the real elegant, genius part of it, which is, so where's that gold coming from? Well, we know. London, to a lesser extent New York, to Switzerland, on to their trading partners. So, for example...
So rather than what the U.S. did is okay, we traded, here's some surplus, we'll give you the gold,
our fixed rate, our gold at a fixed rate.
And China is no, we're not going to give you our gold. Here's the Yuan, you go buy your own gold.
You go buy your own gold, not our gold. And better yet, you buy the Americans and the Brits gold. And the Brits gold...
But can they buy gold in Yuan?
Yeah. Yes. If you look, there was an IMF report early 2023 looking at the internationalization of the renminbi. And it showed a map of offshore Yuan clearing arrangements. UK, Switzerland, UAE, Singapore. And what do all these things have in common? Along with, of course, Hong Kong. But there were some others as well. But they're all gold hubs. They're all the physical gold trading hubs. So you can convert Yuan into whatever, get the gold, and go home. And so then you look and say, okay, well, is it showing up in flows? Yeah, we all know that the flow of gold from west to east into China has been accelerating meaningfully. But interestingly, since 2022, Swiss exports of gold from into Gulf Coast countries, into Gulf Arab OPEC suppliers of China, have gone from 80 tons a year to 300 to 350 tons a year. Wow. And it's still growing. So you can see this trade happening, and it's still not well understood in sort of traditional finance that the Achilles heel of the dollar system is the unallocated gold market centered in London. You just keep, we'll take more, we'll take more, we'll take more, we'll take more, and you either at some point have to let the price of gold rise or you have to declare force majeure. And we saw what happens when you declare force majeure in the nickel market in London a couple years ago. The price goes up like 3x overnight. And that's important because ultimately when gold goes up, inflation expectations in the dollar go up, inflation rates in the dollar go up. And so this is the arbitrage that the Chinese are doing. The other thing it does is that it sets up ultimately, historically, when oil was only priced in dollars, when all commodities were only priced in dollars, gold going up 50% in yuan, like it has in the last 18 months, would mean the yuan's collapsing because there's no other way. When oil is priced in yuan, and it doesn't have to be a lot, it doesn't have to be the majority, it just has to be a decent amount, 5-10%, and it's doing that. When oil's priced in yuan and gold goes up in yuan, that's no longer the yuan is collapsing. That is, gold buys more oil in China than it does in dollars. And so now capital always flows where it's treated best. Gold's just capital, so it's going to flow. Gold's going to flow there, and that sets up this arbitrage, which has been done throughout history. I wrote about it this week in the Spanish Empire. These arbitrages were being done 500 years ago. But if the Anglo-Americans using mostly paper gold say that gold to oil ratio is 20 barrels per ounce of gold, and China and Russia are transacting in physical at 30 barrels per ounce, just to pick two numbers, it sets up a very easy arbitrage. Go to London, sell oil futures, buy an ounce of gold, buy 20 barrels of oil futures, buy an ounce of gold, take physical delivery from London, send it to China, where it never comes back, and sell it for 30 barrels. The Yuan oil contract has this little provision where you can take your profits in any currency you want. It's not well understood that the Chinese capital account is open through gold and through oil on a limited basis. Take the money out, pay back your 20 barrels short, because you get 30 barrels for your, get your 30 barrels for your 1 ounce in China, pay back your 20 barrels short, you get 10 free barrels of oil. Do it again.
Yeah.
Do it again. And the oil market is 12 to 15 times the size of the global gold market in annual physical gold production. Yeah. Like, they will drain the gold. So we're watching them use this as a virtuous system towards something that is better for not just them, but I think for the world. But it's also being weaponized in a way that, like, look, if you do something we don't like, if you go too far with Taiwan, if you give Taiwan the wrong weapons system, we'll get aggressive. We'll say we'll do 40 barrels with the Russians. The Russians are happy to do it. What
would aggressive be then? What would they do?
I think you could drain London a lot faster. They drain London a lot faster, and either the price of gold goes up a lot in dollar terms, which then creates inflation expectations. If inflation expectations go up in the US, because if you look over time, it's not a perfect correlation, but it's a very positive correlation. As gold goes up, US inflation expectations go up. If the inflation expectations go up, rates go up. If rates go up, the debt blows up.
Why would they only hold that in their back pocket in case of some provocation versus, like, why not just do that now?
I think number one, there is a mutually assured destruction aspect to it. Their economy isn't doing great either. We could compensate by raising rates to 10% or 15% and blowing up our economy, blowing up their economy. We could put trade tariffs on their products. None of these things would be good for us or our bond market either, but there's things we could do.
They need us to buy their goods still.
They still need us to buy a lot of goods.
It's dwindling, but they still need us.
Yeah. So there's, and again, going back to the point we made before, I don't think anybody in the world wants the 1913 to 1945 period. I think there is still some level of sanity at the highest levels in these countries that understand, look, there is this transition. We do have competing self-interests that we need to go, and there is this economic transition taking place, and let's avoid this. And so it's very possible. I think when Yellen went to China in November, I think she went there and said, listen, you need to strengthen Yuan. I think the Chinese are like, piss off. If you want the Yuan up and the dollar down, bid gold.
Yeah.
And there were rumblings, credible rumblings, that the U.S. Treasury was buying a little gold. And we certainly have seen gold rise meaningfully since then. So I think gold is kind of the pivot for doing that for some of this for the time being. So I don't think it's in their interest to do that. I think you would rather, big changes aren't good for anybody.
Yeah.
Big fast changes aren't good for anybody.
Yeah. So it sounds like this is happening. People can see it. Again, right? Governments are smart enough to see what's going on. The writing is on the wall, so to speak. Jerome Powell, was it a year ago, said that he could see maybe there's more than one reserve currency. I don't know exactly what that means, but do you think there's a case where the U.S. sees what's going on and rather than being a victim of this situation decides to sort of preempt it or move in advance of that and tries to revalue gold on their own or something like that?
Yeah, I do. I think there are ways out of this fiscal situation. It's effectively a dollar devaluation. That's in the cake at this point. It's a question of, I think it was actually Putin who said it. It's like, if there's going to be a fight, the best thing to do is pick the time and spot for the fight, right? Where it's most advantageous to you. If there's going to be a devaluation, why not use it to pick the time, pick the spot, use it to your advantage? Because a devaluation's happening. That has to happen given the debt and everything we talked about before. There is a financial accounting manual for Federal Reserve banks. It's a public document. Latest update was April 2024. You can Google it. Section 2.10 says the president can instruct the Secretary of the Treasury to tell the Fed to revalue the gold, U.S. official gold. And then the accounting treatment of that is makes a deposit into the Treasury General Account, or TGA, which is just the Treasury's bank checking account they can do whatever they want with. So, president could say, listen, revalue it to $20,000 an ounce, every $4,000 per ounce, given 261 million ounces of official gold roughly. Every $4,000 is $1 trillion. 20,000 an ounce is 20 trillion into the TGA, 5 trillion into the TGA. Buy back the long end of the curve, devalue the dollar, fund industrial policy, reshore. There's a lot of leeway, things you could do with that basically take a U.S. debt crisis off the table, position the U.S. economy for growth. Sort of anesthetize the bond market, as I've said to clients.
How does that solve the debt crisis? Because $5 trillion is a drop in the bucket to the $35 trillion of debt, and then you've shot your shot. Now you're out of the gold.
Well, you don't. The gold doesn't leave. It's just an accounting treatment. The gold never moves in the vault. It's just money creation, pure. It's just straight money creation with no offsetting debt. So let's say there's $35 trillion in debt. The Treasury market's 27 trillion, the nets and various Xing out. Okay, so you can buy back 5 trillion overnight, all at the long end, basically, all the way down. Maybe it needs to be more than 20,000, maybe it needs to be more than 5 trillion. By doing that, you're going to be replacing bondholders with cash. They're going to go out and they're going to buy something else with that cash, freshly printed $5 trillion. Being injected into the economy. You'll be growing the monetary base by $5 trillion.
Yeah, so the GDP would skyrocket.
GDP skyrockets, inflation skyrockets. Fed's going to probably have to maybe do a little bit of QE in there, but maybe not, because if you buy back the long end, there's no market. The long end is no longer a market. It's basically yield curve control. And then once, by virtue of reducing the debt, removing the long end blowout as a risk, then you can do some things on the fiscal side, whatever. GDP's already be skyrocketing anyway, inflation will be skyrocketing. And you end up with debt to GDP maybe back to 60, 70%. Now the Fed is in a position where they can raise rates to fight inflation. They might need to do some creative
Inflation things. Would be so high. I mean, if you raise gold to 20,000, the whole world benefits from that.
Yeah.
Russia is going to benefit. Yep. China is going to benefit. Yep. And so now you have all of this money globally that's going to be sloshing around.
Yep.
And based off of sort of the way it's been going, maybe a lot of that capital comes to the United States.
It could.
So then we have massive inflation, right? You mentioned the Spanish Empire, right? So they went and discovered the gold in Peru, or the silver, brought that back, created massive inflation, right?
Yep.
So
that's in the cake, though, right? Like I was talking with Dylan LeClaire yesterday. It was, we had a 25 to 30% aggregate inflation over 2 years, and debt to GDP didn't move. right? Debt to GDP was 121, it's 122% now, which tells you something really important. The inflation shock playbook that they were trying to run, inflation shock financial repression playbook, 25 to 30 wasn't enough. It needed to be 50, 60, or 60, 80% inflation for 2 years. And now because they were not brave enough, not courageous enough to do it right the first time, now it has to be like the 60, 80, those types of inflation numbers in a compressed period of time. That's what we're dealing with here because the debt and deficit levels are so high, and that's unpleasant, et cetera, et cetera. But Israel had 200% inflation for a couple of years in the 80s. Like no zombies, no collapse, no it just. And
I mean
it's a smaller economy. But that just goes to show, it can be done. It will be tricky, but we're going to have high inflation.
You reference a lot American with Argentine vibes is how you say it, right? So if you look at Argentina, who's had triple-digit inflation for a long time, I haven't been there, but according to many people I know who have, our friend George Gammon was down there recently. He's like, you wouldn't know it. You wouldn't know it when you're down there.
The only people I talk to that equate like really a period of really high inflation with like collapse of everything and zombies and all this stuff are Americans, and particularly Americans, in the financial centers. Like, oh my God, well, yeah, of course they're like, oh my God, because the real value of their bonds goes poof. But they don't understand. They are what is standing between American national security and where we are today.
Yeah.
Like long-term bonds. So like basically by holding long-term bonds, you're not betting on disinflation or deflation. You are betting on the American government not being willing to run over you to get to a national security position that is acceptable to them.
Yeah.
And in my opinion, people always say, don't bet against the Americans. If you're holding long-term treasuries, you are betting against the Americans. They are going to run over you. They have run over, like, Native Americans. They had treaties. They had promises. How'd that work out, right? Like, it was not in American government's interest.
Yeah.
Long-term bond holders, and especially long-term treasury holders, are in the way of the U.S. government securing its national security interests. They are telling you this every day, both parties, doesn't matter who wins.
Yeah.
And yet people are, it's fascinating to me. It reminds me of like housing in 04, 05. Like the signs are all there. It was like the most obvious thing in the world. It's just a question of when. And,
So now let's run through the mechanics of how Bitcoin could come into play on that.
Sure.
So the U.S. has a lot of gold.
Yep.
The U.S. doesn't really have any Bitcoin. Maybe it does. That's an issue. Could they buy Bitcoin? How would Bitcoin work to kind of take this place of gold or work in conjunction with that?
Yeah, I think it absolutely could. Bitcoin does a lot of the things that gold does better than gold. We've seen, I've posted, everyone knows the charts of Bitcoin over gold over time, right? A lot of volatility, but it's up, right? Gold, Bitcoin is winning against gold over time, unquestionably.
Over the last 13 years, Bitcoin is up 150% and gold is up 4%.
Yeah, and with 90% drawdowns, right? So but absolutely, it's over time with high volatility, it's absolutely outperforming, which makes sense. It is a harder currency. There's less supply growth de facto. There's a lot of ways you could do it. You could do it via what Kennedy talked about yesterday here at the conference, where the government comes in and just starts buying it to reserve. You could, I think we've got, I don't know what the number is, but it's a decent chunk.
210,000, something.
Okay,
like that.
something like that from seizing it from whatever the
about
Silk Road and stuff.
About 1% of the supply.
Yeah, from the Silk Road or whatever. We could force the Germans to sell more of theirs or convince them to sell more of theirs and buy theirs. I think they're going to regret that, but that's neither here nor there. You could issue, one thing you could do is if you came to me and said, Luke, you're Undersecretary of the Treasury, I want you to come up with a proposal for restructuring the U.S. debt. We're in a restructuring situation using Bitcoin. Great. Let's issue $5 or $10 trillion of 30-year paper and yielding 2.5% with a 5% Bitcoin kicker that floats. People would take that down enormously. Yeah. You would be revaluing Bitcoin enormously, right? Because you're going to be issuing, you're going to have to buy the Bitcoin to support that debt, basically, or to backstop at least some of it. Bitcoin's market cap's whatever, 1.3 as we meet. That's one way you could do it. What Kennedy proposed yesterday is another way you could do it. In my opinion, as a markets guy, that's one of the least effective ways to do it. Not jacking his proposal. I like his proposal, but in terms of
which is buying 550 a day.
Right, and announcing it, right?
Yeah.
Like if you announce it, the markets are going to discount that back. If you say, I'm going to be in here buying 550 a day, no matter what, the price of Bitcoin is going to do this. It's going to rocket ship, it'll pull back from some really high number, and then it will kind of flatten out and go steadily higher over time from there. That's like what the chart would do. And so if you say we're going to buy Bitcoin for the next 7 years, the markets are going to go, they're going to discount some big portion of that 7 years of buying in the next 3 months.
Yeah.
And that's why I say I think it's a less effective way to do it. It's not jacking his proposal. It is, from a market's perspective, you're going to get a lot less Bitcoin than if you were to do it secretly. The challenge, of course, is they didn't have the foresight to be doing it secretly over the last 10 years for a number of different, maybe they have, who knows?
Yeah.
Maybe that's, we're going to do it, and oh, by the way, we already have this.
Yeah.
Then you could work it into trade settlement, right? Because ultimately, part of the issue is we've been settling trade with treasuries. This is part of the reason why CDS, why derivatives traders make 5 times what a Boeing engineer makes.
Yeah.
Is because we've been in the debt export business. We need to get out of the debt export business and exchange value for value. So when we run, if you're going to use Bitcoin in this manner to weaken the dollar, whatever, once something you do is say, listen, we're going to settle trade in Bitcoin, not treasuries anymore. And as you do that, following the Americans' lead, everyone's going to understand Bitcoin. They're going to want to be, because one of our big advantages is the rule of law, the sort of the social cultural side.
Used to be.
Yeah, right. I mean, we're chipping away at that as fast as we can. That's a separate discussion.
Yeah.
Anyway, so you use the Bitcoin basically becomes the reference point instead of gold in trade with the Americans. Now, that means what are we running? $1.1 trillion trade deficit. That's a lot of Bitcoin buying. It ain't going to take place. 68,000.
Yeah.
It's going to be a lot higher. And again, that then gets into, okay, well then who buys the extra 400 or 500 billion in treasury paper that foreigners are buying this year? The Fed, their proxies.
Yeah.
The Bitcoin we hold, it bids up, you can buy it. There's a lot of flexibility, but it basically is an aggressive, proactive step that restructures the system in one fell swoop, which leads to some interesting points of there's a lot of people that think the dollar system is going to, nothing's going to change until we get a conference and we meet with everybody. Not necessarily. The president could do this over a weekend. Yeah. And you will come in and dollars limit down, S&P's limit up, bonds are not trading for 5 days because they've been frozen. The market's just closed while they sort of settle that out. Thank you for your donation to the restructuring of the American debt, bondholders. And quite honestly, a lot of times in history, this is more how these things work out. But and maybe it is just gradual, but I think it's more likely to be not gradual.
Yeah. If Trump or RFK win, that's a somewhat probable scenario. Maybe not the 550 a day, but something like that, potentially. If Kamala wins, it's probably the opposite, so we'll see how that shakes out. We got to wrap this up. I know we got to get going here. Maybe give me the short version. The world is maybe more uncertain now. It seems like uncertain than it has been in my lifetime for sure. So who knows what could happen. The difference of Trump, RFK versus Kamala is a massive, drastic outcome. But given the sort of fiscal situation, the debt situation we're in, over a long period of time, it almost seems a little bit more certain of what's going to happen. So one thing that I always find confusing when you hear different things like this is over what time frame. So where do you think things end up by the end of the decade, let's say in 5-6 years from now, and maybe in 10-15 years from now?
I think by the end of the decade, the two competing forces of the exponential growth of the debt and the exponential deflationary impacts of the technology, AI, et cetera, bring forward what we'll call a United States Liz Truss moment. And that forces some sort of yield curve control / other extreme fix that we just discussed, whether it's Bitcoin, whether it's gold, something like that. It's very inflationary. Bondholders get killed on a real basis. They're going to get paid every dime they're owed. The Western sovereigns will get paid every dime they're owed in fiat currency terms are going to lose a lot on a real basis relative to gold, Bitcoin especially, but stocks, commodities as well. I think once that happens, de facto, that forces either gold or Bitcoin back to being the reserve asset of the world. The dollar system will have been restructured. And
by the end of the decade, you think?
Mm-hmm. The math tells you that that's what's going to happen. And what I mean by that is the dollar system post-71 is US dollars reserve currency, treasuries a reserve asset, primary reserve asset. Already we are seeing treasuries as a primary reserve asset. We're 10 years into that. That is ending. That is ending and dead. Central banks haven't bought one on net in 10 years. They have been buying gold. And so then gold or Bitcoin become the reference point, and we have a currency system, a global trade system that trades on balance of payments fundamentals, not on relative rates or on sort of this dollar-centric system, euro-dollar system, sort of artificial demand. And what that means then is the dollar's not the cleanest dirty shirt, it's the dirtiest dirty shirt, because we have the biggest trade deficit followed by the Brits. And then, basically as you look at the SDR currencies, Yuan goes up, yen goes up, euro goes up a little, pound goes down, dollar goes down a ton against gold and Bitcoin, and they re-rate around those pivots. And that's a much better system for the entire world. You get much more balanced economies.
Everybody but the bondholders.
Everybody but the bondholders. And they had 40 years.
Yeah.
Move on. Things change.
Okay, we'll stop with that. So by the end of the decade, that's some big moves. That'll be interesting to see. I, of course, believe that Bitcoin will be much higher. So I'm in camp with you. Asset prices are higher across the board because the dollar's going down. All right, we'll wrap it up with that. We cover everything?
I think so.
Okay, so Forest for the Trees, FFT, we'll link to that down below. Check that out. Follow them on Twitter for a lot of good updates as well. And we'll wrap it up with that. Thanks, Luke.
Thanks for having me on, Mark. It was great being here.